My name is Sandra Henry. I am the Learning Services Assistant here at Philanthropy, New York. Thank you all for coming all bright and early. I hope everyone's well caffeinated and ready for an exciting day. Just want to give a special welcome to those who are listening in via webcast, and to just share two quick reminders for those folks. Please make sure that your computer microphones are muted. The instructions on how to do so are in the email that you received yesterday. If you run into any technical problems, please email support@philanthropynewyork.org, and someone will be able to assist you via online. So without further ado, I want to thank Candice Meth for coming to lead this morning's session. She is the Senior Manager for the Not-for-Profit Services Group at EisnerAmper and has been doing these with Philanthropy New York for some time, so she is well versed, and again, we thank her for coming. Thank you, Candice.
Thank you. Great. So what we're going to do today is we're going to talk through a nonprofit's financial statement and highlight what you should be looking for. We're going to talk about what's new specifically for 2012, who actually is looking at these financials and what it means to them. We're going to do some analysis of the financials and point out some red flags. And we'll also be looking at a sample set of financial statements. So most people like to save the what's new till the end, but I like to lead with my really exciting news. So I'm going to start out with the very latest in the marketplace in terms of nonprofits. And the first thing is the Clarity Project, which has been called a quiet revolution. This is really the agency's rewriting the auditing standards to make them clear for auditors. And most of you would say, well, why do you care? And the reason why you care is because it actually changed the wording in the auditor's report. So the opinion page, the language has actually changed there. And so that's something to know, and that will affect all December 2012 year ends and going forward. So this is something that you just want to take a look at. The other change that you might be interested in is that they changed the standards for group audit. What a group audit would be is, for example, when you look at an opinion and the auditor says that they've placed reliance on some other auditor's work for different segments of that nonprofit, or, for example, if the entity is based in New York, but they have a Florida component, and so the Florida office of this audit firm is doing that particular portion of the audit. What this has done now is it said actually that the main partner in charge of overseeing the entire audit needs to be more involved in the audits of the segment. So that's actually a really good thing in terms of tightening up controls. So it basically means that your auditors have to do a little bit more work on their side, but at the same time that only benefits the nonprofit in getting an even better product when they get their audit. The other new thing that's out is proposed legislation, the New York State Revitalization Act. This was actually proposed in the last legislative session, right before the legislative session was going to end. So it was proposed kind of knowing that it wouldn't pass. But if you read that bill, it was quite lengthy. I believe it was something like 80 pages. And it had a lot of new things for nonprofits that are organized in New York. Things such as mandatory meetings with your auditors. The audit committee must meet with the auditors twice. If you're going to have a related party transaction, it would require a 2/3 vote of the board. Also, that you'd have to have 3 independent members on your audit committee. Independent meaning that they're not related in any sort of way to management or to the entity itself. And other things in there that are very important are that they want to increase the threshold for requiring an audit in the state of New York. Right now it's set at $250,000. So any entity that raises funds more than $250,000 in the state of New York is required to have an audit. They actually want to raise that to $500,000. And while that seems like a jump, actually New York is behind. Most states have raised the threshold. New York stayed with the old threshold. And the reason why they want to do this is actually New York has not rewritten its nonprofit law since the early 70s. So we're really working under a very archaic law. So the point of this Revitalization Act is actually 3 tenets. What they're trying to do is rewrite the law so that it's more modern. They're actually trying to reduce the burden on nonprofits in terms of reporting. As you know, many nonprofits get money from federal agencies, state agencies, as well as outside donors, and they have multiple reporting requirements. So they're actually trying to streamline that process to make it easier on nonprofits. And they're also trying to strengthen governance. So they want to incorporate something to the effect of the audit committee relationship to the nonprofit, because right now in the law it says nothing about an audit committee. So they're going to rewrite the law to actually require you to have an audit committee, as I mentioned, 3 independent members, and actually try to put into the law how many times you need to meet with the auditors, just to really strengthen that form of governance. The other thing I want to point out, because it affects most people in the room, is they want to do away with things that they don't think are really necessary. For example, for private foundations, how many of you know about the law journal ad that you have to place once the 990-PF has been filed? It's something that most states haven't done for quite some time. New York is one of the last states that actually still requires that. So they want to do away with things like that. The other thing that they want to do away with is right now the law specifically says you cannot take a vote online. So the board is not allowed to take action through email. You're supposed to do everything either on the phone or in person. Again, that's just simply not keeping with modern times. Half of the board meetings now are using Skype and whatnot. So they want to rewrite the law to incorporate modern technology. I'm frozen. Okay, so this is the new format for the letter. How many people in the room have picked up an audit report and scrolled the entire letter and still can't find where we actually give our opinion? Anyone? I've done that multiple times. I've read the entire thing and said, wait, where did they actually give their opinion in here? I missed it somehow. So the point of redoing the format was literally to highlight to you each section. So the report on the financial statements telling you what we did and what period we're reporting on, explaining what management's responsibility is in terms of these financial statements, clearly stating what the auditor's responsibility is in terms of these financial statements. And then if you scroll all the way to the bottom, lo and behold, you have the opinion. Nice and highlighted for you, you can't possibly miss it. So the point of this, and this is literally because of the clarity standards, so this is only going to take place for December 31st, 2012 and going forward. You won't see this opinion for old audits. This is literally just to help the reader identify exactly what they're looking at and highlight our opinion to you, which is important to note. When you're looking at that opinion page, there's certain things that you want to be on the lookout for. The first is the type of opinion. Typically, what you've seen in the last one, and I'll just go back for 1 second, if you could just scroll down again. What we say here is that in accordance with generally accepted auditing standards, the financial statements present fairly in all material respects. This is what's known as an unqualified opinion. I've always felt like that was very counterintuitive. When you say it's unqualified, it sounds like it's not doing a good job. But actually, unqualified is the best you can get. So this is a good opinion. This is what we call a clean opinion, unqualified. The next level of opinion would be a qualified opinion. And a qualified opinion is basically your except for, right? So it says everything was fine except for this one thing that we just want to highlight to you, that for whatever reason we weren't able to get comfortable with, or maybe we just feel we might have an issue with, but it's not material enough to make the financial statements not in accordance with GAAP or whatnot. So sometimes you'll see an except for paragraph, and that's called a qualified opinion. The next level down is what's called a disclaimer opinion, right? And a disclaimer is usually some sort of scope limitation. Something happened during the audit where the auditor was not actually able to perform all of their procedures, either because they couldn't get comfort on something or because the client wouldn't allow them to do certain things. And so what the disclaimer is basically saying is we couldn't perform this audit in accordance with generally accepted auditing standards. So we're disclaiming. We're saying that there's something that we can't do. Where you'll see this a lot, actually, is if you look at the audited financial statements for a 403B plan. These days, you're seeing a disclaimer opinion, and the reason being is because 403B plans, nonprofits, weren't always subject to audit. They just recently became subject to audit. And we cannot get comfortable with the beginning net assets because we have to accept on fact what the opening number is based on what they're telling us. And there's no way for us to go back and test that. So we're disclaiming. We're basically saying to you, there's no way for us to get comfortable with that beginning number. So what we're doing is we're disclaiming that the beginning balance may or may not be right, but we're accepting it as true, and we're moving forward. Okay, so that's a popular place where you'll see a disclaimer. And the last one, the very bad one, is an adverse opinion. And what that basically says is we can't tell you that this is free from misstatement. We're not sure. Or the client is not presenting financial statements that are in consistency with GAAP, generally accepted accounting principles. So if you've got an adverse opinion, something went very wrong. And you can't rely on those numbers is basically what that's saying. Okay. You also want to take a look at the last date of Fieldwork. And you will see that actually when you're here and you scroll down all the way to the bottom. The letter is dated, right? Give me 1 second. The letter is dated. Here we've left it blank, but it would be dated the last day that we received a piece of evidence that we needed for the audit. Okay. Typically, actually, that last piece of evidence is either going to be the letter from the lawyer saying that through this date, we are not aware of any proposed litigation, or it's going to be the representation letter coming from management saying that we've represented to you through this date that everything is copacetic and, you know, we've given you everything you've asked for. But that date is going to be the day that we get the last piece of evidence that we need to wrap up the audit. I always like to look at that date in comparison to the year end and see how much time has passed, right? So if I got a December year end and I'm looking at a November date, that means that it took 11 months for them to get their audit wrapped up. And maybe there's a very good reason for that. But that's usually a question that I might want to pose to them. You know, I noticed that you guys just wrapped up your audit. And, oh, by the way, your tax return was due on the 15th of November as well. So it really seems like you were rushing at the last minute. Did something happen? And a lot of times what you'll find out is, for example, that they have some sort of alternative investment where they get a K-1. And that K-1 comes in so late that they can't start their audit until they get that material part of the audit. Or, for example, they have some sort of affiliate that gets audited, and they have to wait until those auditors are done, and then they can rely on that opinion to get the rest of the audit done. So there may be very good reasons why, or it may be that there could have been something wrong. It could be that the auditors were uncomfortable, and they basically walked away and said, you know, we'll come back when you guys have kind of straightened this out. There might be something like that. So you want to see how long the distance is between that date and your year end. We had a question here. Okay, so the question is qualified, unqualified, replacing going concern. And it's not replacing it. Actually, if you have a going concern that will affect your opinion, you will see something about a going concern. But a going concern is almost a separate matter in the fact that every time that we audit a nonprofit, we test to see if they can continue as a going concern, which again is a very difficult terminology to say that something good is happening. The word concern throws people off. It's on the CPA exam and people flunk that question all the time. The ability to continue as a going concern is actually a good thing, right? It's the inability to continue. So it's basically saying, can you continue your operations or can you not continue your operations? So ignore the word concern because that throws everyone off. It's the ability to continue or they can't continue. We have to evaluate whether or not the entity has the ability to continue its operations for a period of time. They are actually currently rewriting that standard. It used to be that you assume that you're testing for 12 months. They've actually taken out the 12-month part and said a reasonable period of time, which makes the whole process very fuzzy. In addition, they've actually taken responsibility away from the auditors and proposed that it's management that's supposed to tell the auditors whether or not they can continue as a going concern, which concerns the accounting community because how many entities are going to raise their hand and say, oh, by the way, we're about to go out of business? You know, I mean, that's not likely to happen. So there's a lot of talk right now about that particular standard and a rewrite of that standard because the way it's written now where you give a threshold 12 months, that's easy for the auditor to take a look at. Where you give the auditor the responsibility that they're supposed to be looking for that makes sense. Where you take that power away and you give it to management, that starts to make people a little bit nervous. The other thing is, so the auditor looks to see right now under the current standard, auditor looks to see if you can continue, let's say, for the next 12 months to stay in operations. Do you have enough money in your bank account to pay your payroll? Can you keep the lights on? You know, do you solely rely on one donor and that donor has gone away and now you've got no new cash coming in, that type of stuff? Do you have bond covenants or loan covenants that you're flunking right now and so the bank is going to yank the loan, those types of things? When we're doing that, the next part of going concern is that we have to go to management and we have to say, what is your plan? And we will include their plan to address this verbatim in the financial statement. So when you say going concern, you will probably see something in the opinion that basically says, oh, and by the way, we have, you know, a disclaimer, we have a qualified opinion because we have an issue about going concern. Please see note, etc. And in the back, you're going to see the note. And the note is going to say what the concern is in terms of their ability to continue operations. And then it's going to literally include management's plan to address this. And management's going to say, you know, subsequent to year-end, we brought in 5 new donors. Subsequent to year-end, we went to a different bank and we got a new loan. Or they're going to talk about what they've done to address the situation so that it shouldn't be an issue going forward. When we look at the period of the report, again, nonprofits can have very different year ends. That is what makes me busy all year long. So you can be looking at December year end. I have August year ends. I have June year ends. I have a May year end. So you just want to take a look and know that you're looking at a particular fiscal year end, and that will impact what you see. For example, if you know that the economy, you know, went south in August, but you're looking at a June year end, they may look strong at the end of their financial statement as compared to December year end nonprofits who got affected by the decline in the market. The other thing is you always want to know, am I looking at a full year? Or is this what we call a stump audit? For whatever reason, they only did an audit of 6 months or whatnot. So you just want to make sure you understand what the period is. You want to look at who the auditor is. That matters, you know, because we always talk about what happened in terms of the frauds out there and, you know, the fact that there was a particular auditor actually in my hometown of New City in Rockland County that issued an audit opinion, and he was a one-man shop, and everyone was accepting his financial statements as true, but no one had ever really heard of him, and in fact, this was one of his few clients. So you want to look at who the name of this firm is. If you've never heard of them, take 2 seconds, Google them. You know, do they actually have a physical presence somewhere in New York? Do they have a nonprofit clients, whatnot? Because that's important to know. When we talk about boilerplate language, when you're looking at the opinion, we have very little variance power. We're basically told what to say in that opinion. So you're not going to see a lot of changes in that opinion. One of the few things that has changed, just go back one. Okay. One of the few things that has changed with the clarity standards is that we've always talked about the fact that we're issuing an opinion on the statement of activities and the cash flows and the financial position. We've never actually put into our opinion itself reference to the notes. Right? We know they're part of the financial statements. In fact, they're an integral part of the financial statements. But we never actually used to make reference to them in our opinion. We are now being told that we have to make reference to them because they are an integral part of the financial statements, and therefore when we give our opinion, we should be mentioning them. Also, you may see, depending on the entity, a reference now in the opinion to the functional expenses. We never used to make reference to the functional expenses, and now if that entity presents a full functional expense schedule, it will be referred to in the opinion as well. So it's forcing the auditors to take more ownership in terms of saying, when we're giving our opinion, we've looked at all of these things, and we agree with management's representation on all of these things, not just the balance sheet, statement activities, et cetera. Okay. The other thing is you always want to know what body of work is happening here. in order to see an unqualified financial statement, it has to be a financial statement in accordance with GAAP, generally accepted accounting principles. GAAP only allows you to use accrual basis, right? So these financial statements, if there's an unqualified opinion, they are definitely using the accrual basis. In the notes of the financials, and we'll go through this later, you will see a note telling you that they're on the accrual basis. But that's the only thing that GAAP will accept. GAAP, as I mentioned before, is generally accepted auditing standards. Again, if for some reason we're not able to follow our own standards, you'll probably see a disclaimer opinion. And then I just mentioned things like a PCAOB. PCAOB doesn't really have jurisdiction over nonprofits. If you see some sort of reference to them, then somehow something is going on here that's really a commercial enterprise. So somehow this nonprofit has teamed up with a for-profit entity if there's reference to PCAOB. Well, that's a good test. Excellent, you stumped the teacher. So right off the top of my head, I can't tell you, but it's public company board. But basically, once Sarbanes-Oxley came out and you had the whole Enron scandal, they created this body to kind of work with the SEC, but you know that every audit firm goes through peer review. So occasionally, I believe it's every 3 or 4 years, the firms audit each other, right? So we have to select a firm who we don't do business with, who is not necessarily in our state, and we don't refer any clients to come in and audit us. And they issue us an opinion. And we have to make that opinion public. So that's a great thing when you're trying to interview accounting firms to say, can I see your latest peer review opinion? And you can know if we got written up for doing anything wrong. The PCAOB is another body that is basically, people that were hired specifically to do this that also come in and review accounting firms. And they look at the public clients, they look at your billing processes, and they basically look at how you're running, but they don't necessarily look at nonprofits. They're really more focused on the SEC clients, your commercial, but they're also focused on the quality controls of the firm. So to the extent that they're monitoring the quality controls of the firm, that benefits any client that a firm might serve, for example, a nonprofit. But basically, they're another body that swings by and does random audits of public accounting firms to provide assurances to the general public that things such as Enron won't happen again. The demise of Anderson is kind of what spurred this on. And the fact that there's been some issues with the SEC. So this is another independent body that's out there doing audits of accounting firms. So when you're looking at the financial statements of a nonprofit, you wonder, well, who cares? Who's invested in these financial statements? Who wants to see it? So certainly state charity officials. As you know, the audited financial statements may be required to be attached to the New York State filing, which is called the CHAR 500, depending on how that entity is registered with the state of New York. Government grantors, a lot of times if you get federal money or state money, there are things within the grant contract that say, these are what you have to provide back to us at the end of the period in order to get your next payment or to qualify for the grant in general. One of those things may be your audited financial statements. Certainly your peer groups are interested in seeing your financial statements. They always want to check to see if their compensation is in line with your compensation. Service users may want to see it. The general public, your donor base, would be interested in seeing the financial statements. The media always has a vested interest in looking at the audited financial statements if they can get their hands on it. The IRS, of course, is interested in the audited financial statements. Watchdog groups are also taking a look at it. And potentially, if there's a problem, you may have the AG's office or legislators looking at it. And finally, the last group is researchers who, again, want to do that comparison and that benchmarking analysis. So we're going to go through the financial statements and talk about some red flags. What I've done for now is I've literally just carved out some of the pieces of the financial statement and some of the notes to talk about the red flags. Then we're going to go through a financial statement in its entirety. So right now we're just kind of carving out those things that I wanted to highlight to you. So when you're looking at the financial statements, you're taking a look at the mix of assets. And one of the reasons why you're doing that is you just want to see how this entity has invested their money. Is it all sitting as cash? Is it all in one particular investment, which, as we've learned, is a little dangerous these days to put all your eggs in one basket. So you just kind of want to take a look at how they're diversifying their assets. There may be further implications to this as well, because depending on what state the nonprofit is incorporated in, different states in their endowment laws now have specific tenets about how you're investing endowment assets. For example, New York actually has principles governing the investments of endowment assets. So it's very important to know the mix and understand why they may have made certain decisions depending on whether or not the entity has an endowment. Current versus long-term assets, how liquid are those assets? If they needed to get their hands on some quick cash, could they? Or have they put themselves in a situation where everything is tied up in, let's say, real estate, and it would be hard for them to get access to the cash? When you take a look at investments, you want to know, am I looking at cost or fair value? One of the reasons why you might see something at cost is because they're invested in something that hasn't been evaluated recently or appraised, and therefore they've determined that it's more conservative to give you the cost basis of this investment than to try to impute some sort of fair value when they can't get verification that that's what it would be worth if they sold it right at 12/31 year end. So you want to know when you're looking at it, is this a cost basis or is this a fair value? And the financial statement should tell you what it's being reported on. Pledges and other receivables, again, you want to take a look at the aging of those. You know, on an accrual basis financial statement, when you're looking at the pledges, they have to be discounted, right? So what you've done is you've brought them to present value. So you've taken a haircut of the pledges to try to give the reader a more realistic picture of, well, this is what they would be worth if they all came due within a year. Sometimes you might see those pledges and it says that they're payable over 10 years and there's no discount there. There's something wrong with that then. So then you would say, okay, well, you know, they didn't show a discount, but I need to, in my reconciliation, understand that these pledges aren't coming in anytime soon. Does this entity have enough cash to pay their bills before these payments come in? What if these donors walk away and they don't fulfill their pledge? You know, these are concerns that you just want to take into account. Contra assets, and again, these are things like the discount or the allowance for uncollectible. These are things that should be set up. So when I'm looking at the balance sheet, I should see something that says pledges receivable net, right? And so right on the balance sheet, it may not tell me what it's net of, but when I get to the notes, it should explain to me what it's net of. The fact that it's net of something is actually a good thing because it's telling me that they've either done a present value discount or they've set up an allowance for uncollectible, which means they're being conservative in their approach. And the same thing, you're allowed to discount your grants payable. So if this entity is planning to pay out monies to other nonprofits, let's say, and they plan to pay those out over the course of 10 years, they're allowed to discount those as well and say, you know, over the course of 10 years, we're going to pay this out, but time value of money, it won't cost us as much. So we can discount that as well. Liquidity. Again, when you take a look at the financial statements of a nonprofit, there is an extreme amount of flexibility allowed. And that's probably why it's so hard when you're analyzing one nonprofit next to another, because the financial statements can look very different, and that's allowed. There's very few things that are hard and fast required in the financial statements of a nonprofit. So because of that, you may see a classified balance sheet, which would be where they put current assets, non-current assets, current liabilities, non-current liabilities. Or you may not see that because that's simply not required. On the commercial side of things, for an SEC client, there's very specific requirements as to how they have to present everything. So there's a lot more comparability when you're looking at a commercial versus a nonprofit. But the good thing is if you do not see a classified balance sheet where they've broken out current assets versus non-current assets, What they're supposed to do instead is put them in order of liquidity. So there is a method to our madness. So when I'm looking at a balance sheet, I should see cash first because it's the most liquid. Then probably I'll see investments because they're the next most liquid. And then at the very bottom, I'll start to see things like fixed assets, the bricks and mortars, the building, because those are the least liquid things that they have. So even if you don't see current versus non-current, the order that they're presented in should be the order of liquidity. Okay. So after you've taken a look at the assets of a nonprofit, the next thing that you're going to start to see are the liabilities. So here you've got your payables and your accruals. You've got deferred revenue, loans, notes, mortgages, commitments, and contingencies. What I want to point out when you're looking at the liabilities is the first thing you're going to see are basically your short-term payables. So what's sitting in account payable at the end of the year, bills that came in that they didn't have a chance to pay, or accruals that they made because they know that the payment was really for this particular fiscal period and they're going to pay it after year end. So I take a look at that and I know that's the short-term liabilities. So I'm kind of going to compare that number against my cash because I know that, you know, right after this year end, they probably paid those off. Then I'm going to look at things like deferred revenue. So deferred revenue basically means that probably this nonprofit had some sort of event right after year end, or perhaps they have a new academic period starting right after year end, and someone paid them in advance, right? So we have the matching principle here, which basically says the money came in early, but this is fee for service, right? The nonprofit has to do something to earn that money. And we're admitting to you that we're not going to earn it until next year. So to be completely upfront and honest with you, we're going to say that we're deferring this revenue because we haven't earned it yet. And the presumption is right in the next fiscal period, either the special event's going to take place or the academic period is going to start, and therefore we will take in that revenue because we will have earned it. We're doing this to be the most conservative because let's say that that event got canceled next year or for whatever reason that child got kicked out of school, we would, let's say, return that money, right? So we're admitting to you that it's ours, we think it's ours, we're going to earn it next period, but if for some reason something horrible happened, we would give it back, and therefore we've earmarked it as deferred. Do you have a question? No. Right, so that's a different thing, and that's actually really important because this is an area where people get confused. So there's a distinction between deferred revenue, which is usually fee for service, right? The nonprofit has to earn that money. They have to run a program or they have to run an event versus an out-and-out donation, right, or a grant that you've received. So if somebody's giving you a contribution, they can put a restriction on it, and they can say, I'm restricting this either for you to use it for teacher salaries, or I'm restricting this because I want you to use it in 2014, because I know in 2014 you guys are doing really big things, and so I'm giving you the money now, but you can't spend it until 2014. So as a donor, I'm allowed to do that. But the way GAAP accounting works, if I give you a contribution in the current year, or if I pledge to you a contribution in the current year, you take it into current year revenue, right? Because you don't have to do anything to earn it. You've earned it, right? I've promised it to you. I've either given you a pledge contract or I've actually given you the check, so you've earned it. The thing that now happens is I've said to you, it's yours, but I've put a little twist on it because I want you to use it for the following purposes. And you're going to then honor my intention. And so what you'll see for any sort of grant that has a condition on it in terms of time or purpose is that will be identified within the net asset section as temporarily restricted, right? Somebody has said to you, this is yours, but you have to use it for a certain purpose or a certain period of time. And so the organization, at the end of the year, if they haven't met that restriction yet, it's going to say, we have this revenue, it's ours, it's part of our net assets, but we're identifying to you that there's a condition on it that we haven't met yet. So we're showing it as temporarily restricted until such time as we meet that condition. Okay. So just going back to liabilities for a second, the next thing you would see is loans, notes, mortgages. Very important to find out who they owe money to. If they have a loan from a bank, or a line of credit or a letter of credit, whatever it might be. Again, you want to go back to the notes of the financial statements and find out what this is all about. And also, are they in compliance with the covenants? I've had numerous clients recently say to me, we knowingly and willingly broke the covenants, but we had to do it, right? Which is a very dangerous thing to do because the bank can yank the loan. You know, the assumption should not be, we did this because we were desperate, but we're going to go back to the bank and cry, and the bank's going to tell us that it's all okay and we're a nonprofit and they understand. You know, the expectation should be before you go ahead and break the covenant that you talk to the bank first, right? So what is the covenant? The covenants may say you need to keep $5 million in unrestricted net assets, right? And so what they're saying there then is that donation we were just talking about doesn't qualify because there's a restriction on it. So they're basically telling you that you need to make sure that you get unrestricted money somehow, or take your investment income that you're earning every year and put it into unrestricted and just leave it there so that you meet their covenant. Or they actually may tell you that you need to maintain some sort of account, money market account or whatever it might be, that must maintain a certain balance. So if you knowingly and willingly break those covenants, they have the right to then basically obviously take away your loan. And now I'm in a situation where am I able to continue as a going concern? Have I put myself into a bad situation? And if I lose this person as a bank, can I replace them? Am I going to be able to get a loan from somebody else, right? So very important to know whether or not they're in compliance with the covenants. The notes to the financial statements may actually tell you these are the covenants and yes, they're in compliance, or they might say nothing, in which case it's a great question to ask. You know, I noticed that you have $30 million worth of outstanding bonds. Just curious, you know, what are the covenants? What do you need to do to be in compliance? So you just want to take a look at that. Then the other thing is commitments and contingencies. You actually won't see this on the balance sheet, right? Commitments and contingencies are basically things out there in the future that are not necessarily accrued within the financial statements, but you've signed some sort of letter saying that you're obligated for this. So what we do on our financial statements is on our balance sheet, we actually put a little parenthetical note that says, please remember to take a look at commitments and contingencies note number 5 in the back of the financial statements, because we're going to tell you in that note everything that isn't necessarily booked, but they're liable for in the future because they've signed some sort of letter. Things that would go there, future lease commitments. So that would be, you know, if you've signed a 15-year lease, you're not required to show that entire liability for every single year on your financial statements, because at any given time you could move out, right? But you've signed the contract, you're in this lease, so a reader should know that you've committed to this 15-year lease, right? Those are types of things that you might see in the commitments or contingencies note. Another thing that you might see in the commitments and contingency note is some sort of legal contingency. It might say, look, there's ongoing litigation. The lawyers at this time don't actually know what our liability is going to be, but they estimate that it could be as much as $1 million, $200,000, whatever it might be. So those are things that you might see as well, which they're not going to book because they don't know whether they're going to succeed or lose in the case. And they actually don't know how much the liability is going to be. And likely, they probably have some sort of insurance that's going to cover some of that liability. So they're not going to book anything until they know really what they're going to pay out of pocket. Okay. Yep. How do we judge the liabilities? Okay. So the question is, how do we judge the commitment and contingencies? And when looking at those, things that I expect to see are probably leases for space, right? And so usually in the notes, and we'll see it later on, usually in the notes they're going to show me the minimum lease commitment payment that they're going to pay for the next 10, 12 years. And they're going to break it out. So they're going to show me at least what they're going to pay every single year for 5 years. I'm going to take a look at that, and I'm going to say, okay, they're in New York City. Real estate in New York City is expensive, right? But I can find out by Googling what a square foot in a building in New York City roughly goes for in any sort of zip code. It's at my disposal. If I see some astronomical rent there, I'm going to say, you know, this nonprofit is spending a heck of a lot of money on rent to be on Park Avenue. You know, is that a good use of their money? Is the fact that they are so interested in being on Park Avenue in this high-rise building and paying all this money on rent, is that interfering with them actually running their programs? Are they going to use my donation to pay their rent as opposed to helping people or whatever they're supposed to be doing? So I might take a look at, the minimum lease commitment amount and see whether or not I think that's reasonable compared to other nonprofits, that are operating in New York. I'm certainly going to look and see if there's any sort of legal contingency, and want to know more information about that. Usually, if it's significant enough to merit disclosure in a financial statement, there's probably something in the press about it also. So, again, if I see something in the financial statements, I can easily just do a Google search, see if it was written up. I hate to say it, and it's a really sad thing, but it seems like a lot of times nonprofits only get publicized in the newspapers when something bad happens. There just doesn't seem to be enough coverage of all the wonderful things that they do. So knowing that if there's a big case out there, it's probably hit the press. And so that's really what I'm looking at. The other thing I'm looking at are what we call those golden contracts that an executive director might have. So maybe on the commitments and contingencies, it says the executive director has a 5-year contract, at which point when they leave, we will pay their health insurance, their life insurance, we'll give them a house, whatever it might be. I might take a look at that and just make sure that I think it's reasonable and necessary, and that it's not some sort of excess benefit or unreasonable to the organization. So those are the things I'm looking at. Okay, now net assets. So net assets is the same concept as retained earnings when you're looking at a commercial entity. And there are categories of net assets, and those categories can get very confusing. So right now we have 3 categories. We have unrestricted, which means that this money is free and clear of any sort of restriction, and the organization can use that money however they would like. So having unrestricted net assets, a healthy balance in that category is a good thing, right? Temporarily restricted means that the money for some reason has a restriction on it, whether it be for purpose or for time. But the presumption is that the organization can meet that restriction, and at some point the money that's in the column temporarily restricted will move over to the unrestricted whenever they've met that obligation, right? Permanently restricted is what we also call endowment, okay? And I just want to clarify for everyone in the room, because this has been something that has been very confusing for a while. Auditors use the term endowment to mean a permanently restricted gift that has come from an outside donor. Auditors use the term endowment to describe a permanently restricted gift that has come from an outside donor. What I mean by that is I am Bob Jones. I have promised this nonprofit a gift of $2 million. And I've said to them that they have to invest that entire amount, the $2 million. They have to lock it away. And then they can use the earnings off of that $2 million to support a particular purpose or to use for whatever they would like, right? So I can actually tell them what I want them to do with the earnings. But by virtue of telling them that the original $2 million has to be locked away in perpetuity, I have created an endowment. I have created a permanently restricted gift, right? And the idea is if they invest wisely, they'll generate income, and that income will sustain them. So you saw this a lot, actually, in the 60s and the 70s, especially with the universities. People would set up endowments because they wanted their name to live on within the university, right? So the idea is that you're trying to give the organization money in their investments so that they will always have some sort of earning stream, and that will keep them going for a long period of time. The problem with those gifts is that the market tanked, right? And so the old law in New York said that if the gift is not worth the same as the original donation amount, you can't touch it, right? So what that meant is I gave you $2 million. The market tanked. The fair value of the $2 million today is 1.8. Because it has dipped in value, even though you didn't do anything, right? Because it has dipped in value, the old law that was written in 1972, I believe, said, well, you can't do anything with the investment earnings this year because it's not worth what it should be worth. So basically, that gift is literally useless to you because it's just sitting there and you're not allowed to touch it, and you're not allowed to touch the earnings until it gets back above $2 million. So what happened? There was an outcry in the marketplace. You know, the nonprofits are suffering. They have all this money sitting in their investments, but they're not allowed to touch any of it, and it's simply unfair. Or my favorite example, Yale, you know, went to their attorney general and said, look, you know, we've got endowments going back to, you know, the olden days. Somebody gave us, you know, $10 million for the horses to be kept on the rail in front of the classrooms, and guess what? We don't have horses anymore, and we don't have rails, and, you know, we can't use this money for its intended purpose, and this man has long since passed away. Give us some relief. Tell us what we can do so that we can start using that money, because otherwise it's sitting there. So what they did is they created a law called UP-NIFA, right? Uniform Prudent Management Investment Funds Act. See, I got that one. And so that law basically gave nonprofits flexibility to say that if you're acting prudently, you should be allowed to dip into the corpus, even though it's not worth the original $2 million, as long as you're not aggressively spending, right? So if you set some sort of rate that seems reasonable, let's say 4% or 5% for the year, then it's fair to you to allow you to use those funds because they went below value through no fault of your own, because the market tanked, not because you did something, right? The other thing they did is they said, send letters to donors, try to track them down and say, hey, you gave me $10 million for horses. We don't have horses anymore. Can you change the designation on this gift? Can I use it for something else? Or if that person has long since passed, then there's something called SIPRE, which is a legal term that says that the organization can basically aggregate all the donors that they can't track down because they've long since passed, go before a judge and say, we would ask for permission for variance on the following gifts because the donor is gone and we can't track anybody down, we can't use it for this purpose, give us permission to do that, right? So they stand in the place of the donor before a judge, and the judge gives them variance power. But that's how serious this is. It's literally serious enough that they have to go to court to get a variance to use the gift. So that tells you how much weight a donor carries in every single state. So their will is to be followed, right? Their donor letter is very important. So we're going to get more into NIFA and UP-NIFA, but just to clarify, so UP-NIFA came out in 2006, and it was a model act put out there for every state to adopt, right? And so most states adopted their own version of UP-NIFA. New York was actually one of the last states to adopt. It took a really long time. But they finally enacted their version, and they called it NIFA. And so every state adopted their own version. They put their little unique twists in it. New York put in this donor notification where not only do you have to track down the donor and say, you know, I think you want me to use this gift for this, but they actually, you have to send a letter to the donor and say, are you okay with this new law that says that I'm allowed to invade your gift? Or would you like to tell me in writing that you don't like the new law and you want me to stick with the old law, right? All of my clients loved this process because they sent out thousands of letters. But all that being said, New York, because they realized this was a really, really difficult task, said if they don't respond in 90 days, they're automatically under the new law, right? So you tried to reach out to them, you sent them the letter. If they don't respond, they're under NIFA. If they respond and they say, I want you to be under the old law, you can't touch my original $2 million, then you need to make sure that you're tracking that, right? So for those clients that have these endowment notes in New York, they may have people that liked the new law, people that wanted the old law, and it gets very confusing. But they have to do this analysis because technically, if they don't do it, the Attorney General could come in and basically say you're not following New York's law. The reason I bring that up is because it's so paramount to know which law is governing the nonprofit that you're looking at. Just because they're located and operating in the state of New York does not mean they follow New York law. How many of you work for nonprofits that are organized in Delaware? Anyone? Okay. The reason why the New York State Revitalization Act came out, one of the main reasons, is that the Attorney General was at some sort of function and he heard a very prominent, high-powered attorney in New York, say that she considers it malpractice to set up a nonprofit in the state of New York because the law is written so badly. And so any client of hers, she tells them to register in Delaware, right? He overheard that. And then he called her a couple months later and he goes, you know, I heard you say this, and I agree with you. And in fact, if you feel that strongly, help me rewrite the law. And so this person, along with a lot of other lawyers, sat down and literally tried to recraft the law to make New York a nonprofit-friendly place, to make nonprofits want to incorporate here instead of going to Delaware. The reason I bring that up is because if you're looking at a New York nonprofit, how do you know whether they're incorporated in New York or Delaware? You have to go to the note section, and it should be the first note, Note A, and it will tell you what state they're incorporated in. Okay? If they're incorporated in Delaware, they don't have to follow NITMIPA, which means they never had to send those letters to the donors. They don't have these specific rules regarding their investments. New York has very specific rules about the investments. So they probably have a little bit more flexibility than if they were incorporated in New York. In addition, this entire Revitalization Act that talks about the audit committee, the 2/3 vote for related parties, talks about executive, those that are incorporated in the state of Delaware may actually not be subject to that. So they may get a pass on having to follow all that stuff because they're not incorporated in the state of New York. So very important to know which state you're in, and that's the law that they're going to follow. Okay.
Does it have the same kind of implications to incorporate in Delaware rather than?
So the question is, in terms of why you would incorporate in Delaware, the idea is that it's more flexible and whatnot. It's a little bit more specific than that, actually. To incorporate in the state of New York, if you have any sort of function, whatever it might be, you have to get permission from all these different organizations before you can actually file your paperwork. For example, if you have an organization that has any sort of educational aspect to it, you actually have to get the Board of Regents to review your application and sign off before you can move along with the process. So the way they structure the law, it is so time-consuming and difficult. And if you have any sort of misspelling on your application, or you somehow messed up a character, it automatically gets rejected. So there are other states that are a little bit more forgiving in terms of the application, and they don't make you go through this process of calling up agencies that don't know who you are, probably really don't care, and are just going to then have to waste time looking at you, and yet you can't get off the ground because you're waiting to get your approval. So it's really a very New York-specific problem because of the way the law was written. Exactly, right. So like I said, most states have rewritten their nonprofit law. New York hasn't touched it since the early 70s. It's time. Okay. All right. Oh, I froze again. Okay. So now taking a look at the statement activities, contributions, restrictions versus conditions. Down below, you're going to see the 3 columns, right? So on the balance sheet, sometimes for a nonprofit, you'll see multiple columns on the balance sheet. That's not required, and actually I think is a little bit confusing because cash is cash. You don't actually have 3 separate accounts for your cash and designations. It's all commingled in the cash account anyway. So you usually, hopefully, will only see 1 column on your balance sheet. However, when you get to your statement of activities, here come all the columns, right? And what these columns are telling you is the story for each of the categories, what happened during the year from beginning to end, right? So this is going to tell me money came in as contributions during the year, how much of that money came in free and clear, unrestricted. How much of that money came in as temporarily restricted. They want me to do something with that money. They have some sort of time designation of whatever it might be. And how many of that came in as endowment, those people that said to me, you must lock this away, right? So that's important to know because when they're reporting that they had a wonderful year in contributions, I'm curious to know, well, how much of that can they touch today and how much of that has restrictions on it, and therefore they're not going to be able to really get their hands on it, right? And then down below, it's going to show investment income. One thing I'm going to point out, and we'll get to it a little bit later, but when I'm looking at investment income, I see an amount in the temporarily restricted column. That probably has to do with the endowment. New York says that every dollar earned off of the endowment is temporarily restricted automatically until the board takes action to designate it, right? So what that means is if I gave you $2 million and I said you must lock this away, but the investment income off of the $2 million you can use for whatever you want, right? That sounds like the investment income should be unrestricted. And New York is basically saying, it's not that we're saying it's restricted, it's that we're saying that we want the board to make a decision as to what to do with that money. So we're going to call it temporarily restricted until the board actually votes to say, this year we earned $300,000, we would like to spend $200,000 on the following, right? And that's called appropriation. So the investment income off the endowment will sit in temporarily restricted until it's appropriated. And we're going to look at the endowment note, and the endowment note is literally going to show you a snapshot of everything that's going on here. It's going to show you the investment income, it's going to show you how much the board appropriated, and then it's going to show you the release, right? So this is the beginning of the story. The end of the story will be when we get to the notes. Okay. Other than that, we're going to take a look at things that they're doing besides getting public support, catalog sales. They've got some split interest agreements. And then below that, can we just scroll down? It says support and revenue before net assets released from restrictions. So basically, this is everything new that came in during the year. And then I've got that 626 positive and negative. The 626 is the amount that they were able to say, some donor gave me money, they wanted it to be used for salaries, I used it for salaries, so I get to move that money now into my unrestricted column. That's why it's a positive and negative. So it's not brand new revenue, it's revenue that's been released, freed of restriction, right? And that brings me down to my total support and revenue at the end of the year. Okay? And then there's always the comparative column so I can see what happened last year. Expenses. So much attention is paid to expenses, obviously, when you're looking at the financial statements, as it should be. And so there are categories of expenses, those that they're using on program, those that they're using basically for administrative reasons, we call that management in general, those that are being used for fundraising. If they're selling some sort of inventory, they may have cost of sales. And then there's something called joint activities that I'll explain for a moment. Usually when we take a look at this, we want to do some sort of ratio analysis. But at the end of the day, and this is very important because people tend to get a little confused with this, expenses by their very nature are always unrestricted, right? What you choose to spend can't have a donor restrictor on it. It's what you're spending that you're netting against the contribution, and the contribution is what they restricted, right? So expenses, always unrestricted. Okay. So just taking a look at some of the things we just mentioned, most of the financial statements you're seeing these days have a functional expense statement in it, right? And that's that statement where they break things down like salaries, advertising, professional fees, and they give you an entire detail of everything they spent on. And they then categorize it as how much was related to programs, how much was related to M&G, and how much was related to fundraising. They're not necessarily required to give you that. The only ones that are required to give you a functional expense statement are health and welfare organizations. But that information gets translated into their tax return, into the 990. So most nonprofits have basically said, if it's out there and available to the public anyway, why don't we just go ahead and stick it in the audited financial statements? And then there's comparability between our audited financial statements and what's going in our tax return, right? So typically you're going to see a statement of functional expenses, but know that it's not required. So if you don't see it, as long as you're not a health and welfare organization, if you don't see it, don't panic. They haven't necessarily done anything wrong. The only thing, and again, remember I told you there's very few requirements for a nonprofit financial statement. Basically, the very few requirements is they have to tell you what their total unrestricted, temporarily restricted, and permanently restricted balances are at the end of the year. Required to tell you that. And they have to, at some point, tell you what their total program expenses were, management and general expenses, and fundraising expenses are. They can tell you that either on their statement of activities, they can tell you that back in a note someplace, but they're required to give you those totals. That's pretty much it. right? I mean, there's very little that they actually have to do within the audited financial statements other than give you a set of comparable financial statements in a format that makes sense and that's in accordance with GAAP. But actual numbers, those are the ones that you should look for that they're required to give. So taking a look, this particular entity decided to not only break out their program number, but break out by program. They're actually listing their 3 major programs. They chose to do that. They certainly didn't have to do that. Then they're telling you what their supporting services are, and that's comprised of management in general and fundraising. And then finally, they've decided to do a presentation, which you can choose to do, which is operating versus non-operating, right? So sometimes you'll hear things like above the line, below the line. What does that all mean? For a nonprofit, it actually could mean whatever they choose to put above the line, below the line. So above the line typically means from their operations, right? We are in the business to provide food to the homeless, right? So above the line is going to be all the contribution revenue that comes in for us to do our service and all the expenses that we lay out to do our service. And those are the things that we consider operating expenses, right? Things that are non-operating expenses are going to be things such as investment results. Some entities consider the unrealized or the realized gains on their investments to be non-operating, right? Because that money is not directly related to their program. That's a decision that they make. You could put that up in operating. You could choose to put that in non-operating. That's up to them. Another thing, though, that you'll typically see that's below the line or being called non-operating are these pension-related charges other than periodic costs. Most nonprofits have some sort of pension plan, whether it be a 401k or a 403b plan. If they have a 403b plan, a lot of times what you're seeing is this very large expense because the expense of healthcare keeps rising. The number of people retiring because of the baby boom is starting to get bigger and bigger. And in order to create or in order to sustain these defined benefit plans, it's very expensive for a nonprofit to do that. They get an actuarial calculation every year that says, in order to continue to fund this plan, you would owe this much, right? And so they're required to record that expense. It's kind of unfair to them because actually what that expense is saying is if every single person retired tomorrow, how much would they have to pay to sustain their health care? And this is a defined benefit plan, right? So it's kind of an unfair expense because it's not real time, right? It's not a real life scenario. But the way that the accounting standards are written, they want to give the reader the worst case scenario. So we're going to make them accrue this very big liability for their pension plan, and the flip side of that is that they're going to take this big expense, right? So in order to be a little bit more fair to the nonprofit, they are allowed to take a look at the expense and determine what's actually related to the current year. You know, what are real pension expenses that happen in the current year versus the rest of it, which is part of this kind of actuarial, fictional scenario that's probably not likely to happen ever, right? And so the part that's not related to the current year, they're allowed to stick below the line, okay? And that was really to be a little bit more fair in terms of the nonprofit, because otherwise, especially in the past couple of years, my clients have gotten hit with $1 million adjustments, $400,000 adjustments, and it's not real cash that they're ever going to lay out. So it's really penalizing them. So these below the line amounts are the amounts that are basically, they're telling you, this has nothing to do with our operations. We had no control over this. It's just the way it is. Okay. The last thing, I'm sorry, one more thing that they're required to show in the financial statements, change in net assets. That line must be in the audited financial statements of any nonprofit. They have to tell you what the quote-unquote net income was for the year. Change in net assets equals net income. Sure. So the things that they need to tell you is they need to tell you the subtotals for unrestricted net assets, temporarily restricted net assets, and permanently restricted net assets. Somewhere within the financials, they need to give you the total program expenses, the total management and general expenses, or they might call it administrative expenses, and the total fundraising expenses. And they are required to tell you the total change in net assets for the year, or that might be called net income. Okay. So here's the statement of functional expenses. Can you just scroll all the way down? Okay. So this is always very interesting because this is really what lets you see what they're spending all their money on, right? And this is what can kind of pop out at you and be like, my goodness, they spend a lot on phones. Or, oh my goodness, they spent so much on their rent. Why, right? So this is a really great statement. If it's in the financial statements, that's excellent. If it's not in the financial statements, you can find it in their tax return. It's page 10, great page. I always go straight to page 10. But you will find this information in both places, right? So as I mentioned, it's only required to be disclosed for a voluntary health and welfare organization. Although I would say a lot of nonprofits are putting it in there anyway, also because their boards want to see this. Their boards are very interested in these numbers. Here you're listing the programs and the supporting services. Again, this entity chose to break out their programs. They list their 3 major programs. They don't have to do that. They could have given you 1 column for program, 1 column for M&G, 1 column for fundraising. And again, they may have more than 1 substantial program. I told you that we were going to talk about joint costs, right? Joint costs are those things that an entity can do that actually serve multiple functions. And I always give the same example because it's probably the one that you'll see most often. An organization sends out a newsletter to their membership. But that newsletter on the last page has a tearaway card requesting donations, right? So is that newsletter program or fundraising? It's literally both. It's a joint cost, right? It needs to be allocated to both pots because it's serving 2 functions, okay? That's what joint costs are. And the reason why we're so interested in this is because the only one that can do that allocation is management, right? Management is the one that knows that they're sending this stuff out, and they're the ones that are in charge of doing the functional allocations. The auditors come in and say, is this reasonable? Well, we may not realize that there are things out there that are serving a dual function. So we may not necessarily know at first that these joint costs are out there. So a lot of press has been surrounding joint costs because they're kind of the underlying secret that it's hard to get your arms around if you don't know exists. And so if they exist, there should be some sort of note in the financial statements that talks about joint costs. And actually, there's a part of the tax return that specifically asks you, did you have any joint cost allocations? Did you do something like this where you took an expense and you said it's related to this and it's related to this, okay? So that's what joint costs are. The other thing that I always tell my clients to do, and we'll see this when we get to the full financial statements, is if they give you a full functional detail, then they will also typically give you a full functional detail for last year because you've got comparative financial statements. They have to give you the detail for both years. Take a look at the allocation percentage. If they allocated 80% to program this year, 10% to M&G, and 10% to fundraising, but last year fundraising was much higher and program was only 60%, what did they do? How did they change their allocation methodology to get better results this year, right? Because they're always striving to get the program percentage to be as high as they can, right? That makes them look better. So I always take a look at the allocation percentage last year to this year and see if it's consistent. And if it's not, I will try to identify which line seems to be allocated completely differently than last year and ask them about it. And literally, I mean, this is part of the audit process, but it's also a really good part of the analysis process. You know, there are things that they will allocate. For example, if they have a professional fundraiser and that person is in their professional fees line, that entire amount that they pay to that person should be in the fundraising column. But they know that having a fundraising expense that's too high looks bad. So last year, let's say it was there. This year, all of a sudden, it's allocated to program. Well, that would make no sense. But I may not know unless I ask the question, right? So I just want to see if anything seems completely different than last year and then just ask. Okay. Statement of cash flows. I think it's useful. I'm not sure how much people really pay attention to this. Maybe they aren't necessarily paying attention because of the way it's presented, but nonprofits typically present their statement of cash flows in the indirect method, okay? There are two methods available to you, direct and indirect. FASB, the accounting board, basically said, go ahead and use whichever method you want, but by the way, we like the direct method. Every entity out there said, well, that's great, but that method's really annoying, so we're all going to use the indirect method, right? And that's what happened. So everyone uses the indirect method. Why? Because it's a lot shorter, it's a lot faster, and then you're just done with it. Oh, and by the way, your accountants could do it for you. You don't have to do it yourself because the numbers just pop out, right? Because no one's using the direct method, and we're in the midst of this convergence to try to get, U.S. standards to match international standards, they're actually thinking of forcing everyone to move to the direct method. If they do that, this cash flow statement, which is usually one page, will probably become 2 to 3 pages long, right? So I'm just going to explain to you real quick the differences between the methods so that in the future, if we do end up changing to the direct method, you'll understand the difference. So the indirect method, which is the shorter method, starts with this change in net assets, or as I like to call, starts with the net income, right? So here's all the revenue net of all the expenses in the year. Below that, all I'm going to do is now back out the pieces that are non-cash transactions, right? So I'm going to back out the depreciation, I'm going to back out the bad debt expense. Those are not things where I actually lay out cash. And I'm going to adjust for all those things, and I'm going to come down to my end true cash number, right? So relatively simple to the point. But the problem with this is that people are actually interested in where you get your cash from. And this doesn't really tell you. This just tells you what the net income was, and then I back out all the things that aren't cash, and I get to my ending cash number. It doesn't tell me the sources and uses of cash. The direct method actually starts with cash from donors, cash from attendees of programs, cash from government, and it literally breaks out each bucket where you get cash from, and then nets those against expenses for programs, expenses, right? And so it's going to show all of your sources and uses of cash to get down to the net income number, and then below it, it's going to do all the same things as this. So indirect starts with net income, adjusts for non-cash items, done. Direct shows all the sources and uses of cash to bring me to my net income number, and then the rest is going to look the same. So that's why the direct is a little bit longer. And in terms of nonprofits, I'm not sure it serves a function because I think we already know where all the cash is coming from. It's either coming from donors or it's coming from attendees of our programs. It's not that tough to figure that out. In the commercial world, I'm sure it's a little bit more difficult, and so it makes more sense. But it doesn't matter. If they decide that the commercial world has to go to direct method, it's going to impact nonprofits also. And just so you know, it's going to be really hard for the nonprofits to start doing this because they've never tracked the money that way to be able to do this sort of presentation. So the year this happens, it's going to be kind of a difficult year to get the financial statements out. They might be a little later than usual. Okay. Other than that, they're going to put everything into 3 categories. The first is going to be operating activities. This is where my eye goes first, right? This is what they're doing. They're in the business to conduct these operations. I'm going to look at net cash provided by operating activities. If I see this as a negative number, and it was a negative number last year, and it's a negative number the year after that, I'm going to be concerned because this is what you're in the business to do, and you seem to be losing money every single year. Why is that, right? The next line is investing activities, and really what's in here is going to be 2 things. It's going to be your literal investments in securities, bonds, whatever it might be, and it's also typically going to be the fixed asset purchases, right? So this, I'm not shocked if I see a negative number because maybe you just bought a building, or maybe you just bought all new chairs and tables, or maybe you had a lot of cash sitting in the bank and you wanted to go into investments to start earning returns. So if I see the investing activities a negative number, that doesn't necessarily scare me, okay? Finally, below that, can you just scroll back? Thank you. Is financing activities. And you're going to see 2 things here, one of which is always going to be your debt activities. So either you got proceeds from a bond issuance or you've been repaying your bonds. So again, I'm either going to see a positive number or a negative number, but I'm not necessarily concerned as long as I knew they had a bond, right? So as long as I saw on the balance sheet that there's a bond outstanding, whether this number is positive or negative doesn't necessarily shock me, right? The other thing that's going to be in here is a number that offsets. So This is where you see contributions restricted for permanent endowment. You see 774000 as a positive number. You will see that exact same number up above as a negative number in operations. What this is basically telling you is that somebody's giving you a permanently restricted gift and that you literally don't have access to that cash, right? So it's an in and out. It's actually not affecting you. It's more of a presentation type thing. It's just bringing the reader the bullet, the highlight of, by the way, I got a permanently restricted gift this year. So to me, it's kind of nonsensical. You know, it's in and it's out. Why do we have to do it? But you do it because they want that highlighted in this statement. Finally, supplementary information. You're required to let the donor know certain things that you may have paid out in cash. Those things are typically interest paid, some sort of donated service, so again, a non-cash transaction, donated supplies. The other thing that might go here is if you actually did pay income taxes. Nonprofits sometimes pay income taxes. You know, your private foundations pay income taxes. A public charity could pay income taxes if they're doing some activity that's been deemed to be UBIT, unrelated business income taxable. So that could be an investment that caused them to have UBIT, or it could be that in addition to providing educational facilities, they've started catering, right? And catering has nothing to do with their educational mission, so that little segment of their business is actually subject to taxes, right? So if they paid anything in terms of taxes, it would be shown down below, and it's just disclosure. It's just for the reader to find out about. Okay, so I just want to get through a little bit more, and then we'll take a quick break. Notes to the financial statements. Again, here is where we begin that very important note that tells you what state we are formed in. We are formed in the state of New York, right? I did that because I wanted you to see what a NIT-MIFA endowment note would look like. So I made sure that we're in New York. It tells you what we're in the business to do. Very important to know what the mission of the organization is, because if you see them doing activities that don't seem in line with their mission, that might be something that would concern you. So here this is going to tell you what their mission is. And then below that, it's going to start to tell you what their basis for accounting is. Again, you saw an unqualified opinion. It should be no shock that you'll see that they're on an accrual basis. There are other bases that they can use. It's called ACBOA, which is basically other accepted, I'll give you the actual term. Hold on. I wrote this one down. Other comprehensive basis of accounting. And so those are actually non-GAAP. So if they are using some sort of basis other than accrual, they won't have this unqualified opinion. But some things like that might be if they're on an income tax basis, if they're telling you they're on a cash basis. And you might see that because, for example, let's say they're a religious organization. They have no tax return filing requirement. They, let's say, have no debt. So the only people interested in their financial statements are probably their board members and maybe donors. So because of that, it doesn't matter to them whether they're GAAP basis or not, right? It doesn't matter to them whether they have a clean GAAP opinion or if they have some sort of disclaimer opinion. So for them, they would prefer to be on a cash basis. And so you might see that because if you have an entity that doesn't have a reporting requirement to some agency, they can do whatever they'd like. Okay? So here's where I told you that I'm just going to highlight a couple of the notes that I thought you might want to focus on. This is the investment note. Very important. Investment note these days probably goes on for pages and pages and pages. Here it's going to tell you what they're invested in and the different types of investments they have. I gave you a note that has all the information. It doesn't have to look like this. I gave you fair value and I gave you cost. They could just give you fair value, right? But typically, as long as we have the information, we want to give you everything so that you can see the pieces of it. Again, you'll notice our private equity investments, the fair value equates to cost. Here might be a situation where you're going to see a note below that says there is no appraisal available for this particular investment, so it's being maintained at cost. So those are things that I would look at and say, oh, wow, why is that the exact same number? That seems odd to me. I also love to take a look at, okay, it's not shocking that my fair value went down. It seems to be the way of the world these days, that the fair values keep decreasing. but did my costs go down, right? So then I can say, okay, well, you know, the value of my investments went down because they liquidated some of the investments. That makes sense. Versus, oh, the value of my investments went down, but they actually pumped more money into investments. That means I had a really bad year, right? So in this case, you see my costs actually went up and my fair value still went down. That means that we just had a really bad year. Okay. The other thing that you want to take a look at is, remember I said that they're in the state of New York, which means they follow NIPMIFA. And NIPMIFA has certain rules about investments. And what NIPMIFA says is that the board really needs to take a look at investments and consider these 8 factors and decide how to prudently invest their money, right? And so the board could, after discussing the 8 factors, say, we think it's prudent to put the entire amount in CDs because the economy is horrible. We think the CDs will hold their value, and we think that's the safest thing to do. And that's okay, and they can make that decision as long as somewhere in their minutes they've had a discussion about why they're doing that, right? And so that's one of the things that I take a look at when I'm looking at investments is, what did they decide to go into? Are they diversified? Did the decisions make sense? I wouldn't necessarily be concerned about an organization these days that's very liquid, that's in bonds or all cash or money market. What's more concerning are those organizations that stuck 100% of their investments in one offshore hedge fund, right? Because it's not liquid. They're probably going to have to ask to get a distribution, and the distribution could take up to a year, however long it comes. And it's not readily valued. Your auditor is going to rely on a value from the Cayman Islands. They can't physically value it themselves. And you've stuck all your eggs in one basket. Is that prudent, right? So that's what would make me more concerned as opposed to somebody who's diversified. Okay, some other things I wanted to point out, concentration of revenue sources. This is a really important note, right? This is the note you get before you get to the next year when you get that going concern note. This is basically saying that we've identified this organization relies on one donor, right? And why is that important or of concern? Well, if they rely on one donor, then in the future they might fail their public support test, right? So they actually may no longer be a public charity. They may start to become a private foundation because they're heavily reliant on one person, and they've done that year after year. Second thing is, what happens if that donor goes away? What if that donor gets mad at them? Or, as I had an organization do, they were relying on a donor who made a very significant pledge. They went ahead and put his name into the side of a building. They constructed in his honor, and then he walked away from the pledge. And just so you know, technically, if you have a written agreement, blah, 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 you probably could try to sue the donor. Most nonprofits don't go that route because the rules are a little wishy-washy. It's negative press for them. It scares away other donors from making pledge commitments. So they are very reluctant to actually pursue legal action against that person. Instead, they sandblasted his name out of the wall. But it really hurt them because they were relying on that money, right? And so, you know, it used to be, oh, well, this person's very wealthy and they would never do that. But these days, you know, given the economy, it could affect even the wealthiest of people. So you really, if you see a concentration note, you want to understand what that concentration is, and you want to understand management's plan to try to move away from that concentration if they can, right? Related party transactions. As I mentioned, this is a focal point for the Attorney General in New York. He seems obsessed with related party transactions. We all know that it may be that you have a board member who happens to work for a press agency or happens to work at a law firm, and he can get you deeply discounted prices, so why wouldn't you use his firm instead of paying fair value? I mean, that all makes sense. And that's the great thing about nonprofits. Your board members are volunteering their time, and if they can, volunteering their service or getting you a discount on service. That all seems fine. But there's this concern that there's some sort of excess benefit transaction, that instead of somebody doing something nice, they're taking advantage of the charity. So these related party transactions are going to get a lot more press. They should be in the financial statements. You'll also see them in the tax returns, and we'll talk about that in future sessions. But here we've just let you know that there are related financial transactions between two entities, and we've given you the amount that they paid. And we've also told you that we're related to a 501c4 entity, and again, how much money took place between the two. So not a problem, not a big deal. We're not saying they did anything wrong, but we're bringing it to your attention. We're letting you know it's out there. The board is aware of it. Hopefully everyone signed a conflict of interest statement. And so when they entered into this transaction, they knew that it was with a related party. And so just something to keep your eye on, because I think you'll start to see more and more press. If the Revitalization Act gets proposed, it's supposed to, I hear, maybe come out in the next 2 weeks. So if it gets proposed and they actually put into the law that you need a 2/3 vote of the board every single time you're going to a related party transaction, it's going to get a lot of press because that's a lot of work. Okay. Other disclosures that you might want to take a look at, there's a disclosure that's required regarding subsequent events. It's kind of a non-event, if you will, because all it says is that management has reviewed the activities of the organization through to the date of this report, and we're not aware of anything that needs to be disclosed. So it's really an affirmation in the abstract, if you will. It's just telling you that there's nothing else that should be in here, right? But management has to do that now. Management highlights, there's been some discussion as to whether management should be attaching a cover sheet like commercial organizations do when they issue their annual report. It's a little dicey as to what would go into that cover sheet, because if you're just an organization that lives off of your donations, what are you really going to talk about without embarrassing your donors? So I don't know whether or not that'll ever happen. And then donated materials and services. These days where money is very tight, instead of getting cash donations, a lot of times organizations are getting donations of actual goods or donations of services. And that's absolutely fine, but you want to just understand the process for how they value them. The way you value a donated good is not what it's worth to you, it's what it's worth on the open market, right? So perfect example, there was an organization that got donated pharmaceutical drugs. And it was an entity that really couldn't use those. I mean, they had no purpose for that. So to them, it was almost valueless because they wouldn't be able to pass that along to the people that they were serving. But it doesn't matter because those pharmaceuticals have a value on the open market. But the important thing is you don't want to value it at what the company told you it's worth, right? Because the pharmaceutical company is probably going to give you the highest value for what those drugs are worth. But if you went online and you looked up what this pill is actually going for in the open market, it's a much lower value. The entity should be valuing it at what it's worth on the open market, not what they're being told it's worth by the donor. Okay. So again, you just want to kind of understand if they have significant donated goods, how they valued it, and it should be that we valued it at fair value. Okay. All right. Everyone take a break? Yeah? Okay. We're going to let's take a 5-minute break. Uh-huh.
Right, so we have not brought out the money yet. So that should be backed out from the cash.
It's actually not. No, it's actually not in the cash flow because if you report it as temporarily restricted, it's already up in this net asset number. So it's part of this first number, and then you never see it again if it's temporarily restricted.
But we have not drawn out cash yet. No non-cash.
Right.
So we have to class it out in order to get the cash number?
Not if you booked it as a temporarily restricted net asset. If you booked it as deferred revenue, then yes, you would back it out, and it would be over here in this section. But if you booked it as temporarily restricted, you booked it as a contribution in the current year. So you made it seem like you got the cash. You just didn't get to spend it yet. If you didn't get the cash and you have to do something to earn that cash, then you might have wanted to book it as deferred revenue. So it might be how you booked it.
Okay. And also, regarding the investment, are we required to fair value? Oh, because they
Okay, we're going to go ahead and get started. So now when we do the analysis, the first thing that we're going to do is we're going to start to ask the questions. Again, I told you in Note A, the first section is where they discuss the mission of the organization. We want to take a look when we're looking at the functional expenses, when we're looking at the activities of the organization. Are they in compliance with their own mission? And this is actually starting to become more of an issue because, for example, there were organizations out there that were in business, let's say, to help those with the AIDS epidemic. Well, the drugs have gotten a lot better. Fewer people are coming down with AIDS. They're living longer. And so those organizations don't want to go out of business. They're well established, so they're trying to find other things that they can do to stay in business, which is absolutely fine, and they're still doing charitable work. But because they've now switched their scope and they're working on other things, they could be in jeopardy of losing their tax status because they've gone outside their mission. So what they would need to do is really basically have their lawyer redraft their bylaws, submit them to the IRS, and basically say, we'd like to make a change. We'd like to expand our mission to include other health crises, whatever it might be. Okay? Is the organization financially stable? Are the operations acceptable? And here's where we start to do the ratios, right? So the current ratio is basically taking your current assets over your current liabilities. As I mentioned, you may not get a classified balance sheet. You may not get that balance sheet that says, by the way, here are all your current assets, here are all your current liabilities. But you can figure it out because the current assets are those that are most liquid. They will be the top few things that are presented, right? The cash, the investments, those things that they could easily sell. And the current liabilities, again, should be the top few items in the liability section. Your accounts payable, your accrued expenses, and your short-term commitments, right? The quick ratio is similar to the current ratio, but it's not including everything. So it's not including the prepaid, et cetera. So now, and it's not including inventory. So now it's simply my cash, my investments, my receivables divided by my current liabilities, okay? Days of cash on hand, this is always a really good thing to do because you want to take a look at how long could they stay in business based on how they're doing right now, your cash plus your investments over your operating expenses, but backing out those that are non-cash. So you don't want to penalize them for having bad debt write-offs or having depreciation, right? Because that's not an outlay of cash. So operating expenses, but after you've already backed out bad debt and depreciation, divided by 365, that should give you number of days that they could stay in business based on how much cash they have in the bank, right? Receivable turnover, again, this is just saying how they're doing in terms of their collections. Average collection period, I'm not sure that that necessarily is all that important. Debt ratio, they may not have debt, but if they do, you can do this calculation. The bottom three are probably the three that are most talked about. Program services ratio, your program expenses divided by the total expenses. This is the one that the nonprofits care the most about themselves because this is really what the watchdog agencies are rating them on. So they want that percentage to be as high as possible. So that's something that they have a vested interest in making that number look good. Fundraising ratio, fundraising expenses divided by total expenses. This is the number that they want to be the lowest because they don't want you to think that they're taking your generous donations and using it to go out and fundraise. They want you to know that they're using it to help the poor or whatever it might be. I have yet to meet an organization that truly has zero fundraising. I've seen organizations claim that they have $0 of fundraising, but somehow that just doesn't seem realistic to me because really then how are you obtaining your donations? You don't have any development expenses. You didn't do any solicitations. You don't have a single person working in a development office. A lot of times, for example, those social service organizations that get federal and state government contracts, they know that they're not going to get reimbursed for their fundraising expenses. So they try to show that they have no fundraising expenses. And even the auditors that are coming from the state don't find that to be true because they know they're not giving that agency enough money for it to keep going. So clearly they're getting donations, and they're getting donations somehow. So it's not a bad thing to have fundraising expenses. That's the whole point of what I'm saying is it's not a bad thing as long as the percentage is reasonable. Below that is an excellent calculation to do. Cost of fundraising really, what are your fundraising expenses divided by your contributions? This is really important because there are organizations out there that are throwing golf outings and calling it a fundraising event, and it's really not making any money. It's either breaking even or it's losing money because golf outings are expensive. So are they really throwing that golf outing to raise funds, or are they throwing that golf outing because they really enjoy playing golf, right? So those are the types of things where if they're throwing events, are they fruitful events or are they wasteful events? And this is a good calculation to do. Mm-hmm.
Setting up a dialogue with grantees that comes with a certain perception, right? Could be a golf outing that nearly breaks even to the follow through with it. Have another positive effect.
At the Reader's Digest Association, we're a global multi-brand and multi-platform media and direct marketing company that educates, entertains, and connects audiences around the world. Our North American
so the question is, can the golf outing have a different effect? So maybe it's not necessarily to raise money, but maybe it's to build relationships. And so those relationships may turn into contributions down the road. And that certainly makes sense. But one of the things you want to think about then is for the outside donor who's giving, let's say, $1,000, and the literature of the organization says every penny you give us goes to help homeless shelters, or every penny, you know, whatever, is the literature true, right? Because if they just spent $30,000 on a golf outing, can they make the argument that every dollar that came, where did they get the money for the golf outing, right? So absolutely, sometimes these events are not necessarily, you know, big bang for your buck right away. They pay off down the road. You're building relationships. You're hopefully going to bring in that very large pledge. And that may be an excellent reason why you have the event. And so, again, it just asks the question, well, why would you invest in this? I invested in this because I know it's going to pay off a year from now or 2 years from now. But at the same time, you also want to check the literature that they're putting out there about what they're using your money for, and does that stand to be true? Yeah.
It's about the program services ratio, right? Similarly, shouldn't there really be a discussion with management about that ratio, right? Because there's different philosophies around how nonprofits are run, right? I mean, I don't want to work with a team that says, you know, this ratio is an F, right? It's not 72%.
Oh, right, right. Right. So the question is about the program service ratio, and shouldn't there be a discussion with management? That number can fluctuate all over the place. And it's certainly not you or the auditors who's going to say anything, whether it's 60% or 80%. But the watchdog agencies are actually giving them a rating based on what that percentage is, and they've set a number that they have in mind. So if they don't hit that number, they get a lower rating. So because of that, I point this out to you only because there is an innate desire to make that number look a certain way by an organization. And you just need to be cognizant of that when you're reviewing the financial statements, to look at the allocation in the program column and see if that's reasonable. Because you know that they are concerned about their own rating, and so are their allocations reasonable? And so, you know, is it true that they are 80% program related, 87% program related? Is that a reasonable calculation? So certainly it's a management decision no matter what. I mean, management prepares functionals, they do the allocation. The auditor is just reviewing it for reasonableness. And that number can be all over the place. And it, you know, it's hard for an organization to get penalized, let's say, if they had a year where they had to stick certain things in management in general. For example, bad debts go in management in general, or they go in fundraising, whatever it might be. But at the same time, I just point that out to you so you know that there's a vested interest in them to get that number as high as they can. I actually don't know what it is right now because the Better Business Bureau has their own set of criteria. Charity Navigator has their own set of criteria. But I think if you go to Charity Navigator's website, I think they'll tell you the percentage that they target for programs.
Well, but what's actually the most cost? It's really, unfortunately, and everybody's expecting nonprofits to perform services at such unreasonable rates that we as funders have to start on that.
Okay, I just want to get back to here because I just want to wrap up with this. Again, the next page just walks you through doing a current ratio, but I think we've seen that. Again, this page just talks about doing the program service ratio or calculating the fundraising ratio, and it just walks you through some examples. But I want to talk about red flags. In terms of other things to be looking out for just besides the audited financial statements themselves, what is the budget process, right? Are they providing budgets to the board during the year so that the board can make informed decisions? When you're giving a grant, typically they will give you a budget as to how they plan to spend that. Does that budget hold true to what you've seen their audited financial statements say? Are they promising you that they're going to spend, let's say, $30,000 on something, and you're looking at their functional expenses last year and they've never spent a dime on that before? Are they going to be able to meet their expectations, meet their budget, right? Accounting systems, but what are the controls in place? Is it a one-man shop, in which case they probably don't have segregation of duties? Do they have segregation of duties? Have they outsourced their accounting to help strengthen their controls because they know they can't hire that many people? Things like that. Interim reporting, they may or may not create quarterly financial statements. A lot of nonprofits don't do that. So if they don't have interim reporting, I wouldn't necessarily be concerned about that, as long as they have some sort of budgeting process. Ratios, we just talked about. Management letters. How many of you actually get management letters from your grantees? Okay. This is something I always say, ask for. You may or may not get it, but if you get it, it'll be very telling in terms of how they did last year. If there are comments from prior years, those usually get brought forward along with an action plan by management as to how they're going to address it. And then the auditor will say, yes, they addressed it, no, they did not address it. So to the extent that you can get them, they're always very informative, but I understand that a lot of times an organization is very reticent to provide those. We talked about internal controls, tax filings. A public charity obviously is going to file a 990. Other tax filings they need to be filing. If they have a pension plan, they would file a 5500. If they have any sort of unrelated business income tax, they'd be filing a 990T. They may, if they have some sort of LLC attached to them, they may have an LLC filing. So one thing you may want to say is, are you current with all your filings? Have you received any sort of notification from the IRS in the past year? Those are just some good questions to be asking. Cash flows, what's the monitoring process? Do you have some sort of reserve? Some organizations will set aside a reserve that will keep them in business for 3 months, let's say. They think that that's a conservative amount to put aside for, the worst case scenario. Governance structure, again, you just want to see who's reporting to who, and again, take a look at the segregation of duties, and who's on the board. Do they have qualified people on the board with diverse backgrounds? Somebody that would have a finance mind, are they sitting on the board, that type of stuff. Related party relationships, we talked about. Watchdog agency reports, and again, I agree, organizations will get unfairly penalized depending on how their numbers may turn out. I can tell you, and we'll talk about this more in the 990 session, the IRS is trying to make the process better. They have recently come out and said that the bad debt expense does not need to go on the functional expense page. It can go in other reconciling items in the net assets because people are being unfairly penalized for a large bad debt expense hitting their management and general column. They've also, as I mentioned before, said that that pension adjustment does not need to go in the functional expense page. So things like that should hopefully start to help organizations that are getting rated on how that page turns out, make the ratings a little bit more true to life instead of things that are non-cash anyway. But again, it's not a perfect process. Organizations also get rated on how they respond to the governance questions. They are asked, do you have a conflict of interest policy? They are asked, who reviews your 990? They are asked, how do you set compensation? Depending on how they respond, they get a rating as well. So those are also good places to look when you're trying to review what their internal control structure is like. Behind here, this is basically a set of financials. You've seen pieces of this already. I just wanted to give you one complete set so that you could see everything in its proper order. Again, I mentioned with the functionals, you get the current year, and right behind it, you get all of last year. Here's where you can do that analysis. Well, this year, they had 80% in program, and this year they had 73% in program. Okay, does that make sense? You know, fundraising last year was 30%, this year it's 6%. That seems a little odd. Maybe they didn't hold the event this year, and that's why it went down. There could be many reasons why it would change. Again, here are the notes. And we've gone through the ones that I thought were most important. The only thing I just want to finish up with is we talked about the investment note, and I mentioned that the investment note goes on and on and on for a while. You're required to do this fair value analysis where you have to put the assets in buckets, level 1, level 2, level 3. Level 1 being those things that your auditor can independently value. So you hold a share of, let's say, Disney. At any given time, I can go on Google Finance and I can find out what that share is worth. And I can buy that exact same share that you own, right? Number 2 is things that I may not be able to buy the identical thing, and I might not be able to get an identical valuation, but I can get a similar valuation. And that's usually if you're holding debt, right? If I buy debt 10 days after you bought debt, it's not the same debt, but it's going to be worth about the same. Level 3 are going to be those things where I have no way to independently value it. I have to rely on an investment manager. And so that's going to be those limited partnerships, those offshore hedge funds. And the point I bring to you is there's nothing wrong with being in level 3. There seems to be this bad stigma out in the marketplace that if you have level 3 assets, that's a bad thing. It's not necessarily a bad thing. It just means that your auditor can't independently value that. They're relying on somebody else's valuation as of December 31st. If you had only level 3 assets, maybe that would be a cause of concern, not because those assets don't exist, but maybe they're not worth exactly what you're stating they're worth because your auditor couldn't independently value any of them. But again, just so you know, nothing wrong with having level 3. You shouldn't get in trouble if you have level 3 assets. And people get very nervous about that, but really nothing to be nervous about. If you do have level 3 assets, you're required to provide a roll forward of those assets. And so all this is telling you is the level 3 assets we had last year and the activity that happened during the year. And it's literally just here because it's a required disclosure. And you do comparative, so you show last year and the current year. Can you just scroll down? Below that, this is a really important disclosure because it tells you the liquidity of the investments. Typically, if you're in a level 3 asset, it's because it is probably outside the United States. There may be some difficulties in getting out of that asset. You may have hurdles you have to get over. There may be gates. There may be holdback rules. Maybe they're going to hold 10% when you try to liquidate. Maybe you're only allowed to ask for a liquidation every 90 days, whatever it might be. So this table requires you to let the reader know, number 1, do I have any unfunded commitments? A lot of times I go into these limited partnerships and I have committed $10 million in total, but I have to fund those commitments $2 million each year. If I have signed a contract saying that I'm going to fund another $8 million, well, that might not be booked as an accrual in the financial statements, but it should go here so the reader knows, by the way, I'm going to have to make an $8 million capital call in the upcoming years, right? So that's one thing. Number 2, it's telling you how often I can get out of this. And number 3, how much notice I have to give them before I can get out of it. So that's another factor in terms of how we value it. If you're in something and you're saying it's worth $18 million at the end of the year, but you can't get out of it for 90 days, and there's a holdback rule, so they're only going to give you half, then it's never going to be worth what we're saying it's worth in the financial statements, because by the time you actually get that investment, it'll end up being a different number. It'll be 6 months later, it'll be worth something else. You're going to get it in pieces, time value of money. So at the end of the day, you're never going to be able to redeem it for exactly what we're showing in the financial statements, probably why we put it in level 3, right? So those are really the main disclosures I want to show you. Actually, you know what? Let me just show you the last one. Okay. This begins the endowment note. Again, we're letting the reader know that we're following NIP-MIFA. NIP-MIFA requires that, well, actually, in general, the GAAP requires you to disclose the roll forward of the endowment, and you see the column that says unrestricted, and I would say if it walks like a duck and it talks like a duck, it's a duck. Unrestricted is going to be quasi-endowment, which means that the board has said that we're going to set aside $10 million and we're going to call it endowment. And we're going to lock it away and we're going to use the earnings off of it, right? But because the board did it instead of an outside donor, it's actually considered unrestricted because the action of this board could be undone by the next board when they're voted in. So it's not permanently restricted because at any given time it could be undone. But GAAP says if you want to treat it like endowment, include it in the endowment disclosure. So that's in my unrestricted column. My permanent restricted are all the gifts that came from outside donors. So the first two tables just show you the components year to year. You see the negative amount on the donor restricted endowment fund. That's the underwater amount. So when NIPMIFA was passed and it said that you're allowed to spend even if you went underwater, and underwater means I gave you a gift of $2 million, it's not worth $2 million anymore, it's worth $1.8 million. That means it's underwater. NIPMIFA said you can still spend, so people were like, oh, well, I don't have to track underwater anymore. That's not true. You're allowed to still spend, but you're supposed to know that you're spending a gift that went underwater. You're supposed to disclose to the reader that I know that this is underwater and I spent this anyway, right? And so there's nothing wrong with it, but you're just supposed to know, okay? Just scroll down a little bit lower. And then this is the roll forward for the year. In my permanently restricted, all the gifts I had originally at the beginning of the year, my new contributions, my ending value. And my temporarily restricted column, these are the investment earnings that are related to my endowment, okay? So I had $3 million worth of earnings during the year. This is how much I earned during the year. There's that appropriation line. The board has voted to spend $337,139 during the year, okay? So that's that action by the board that they took in the minutes. That's how much they voted to release, which was some calculation they did that was 4% of something, let's say, right? So there's my appropriation. See where it says other changes? Other changes is the 14,104 that I went further underwater during the year. My temporarily restricted column doesn't get punished by the underwater amount. The way that GAAP works is if I went underwater, my unrestricted column gets punished for that, right? So the 14 is in and out, and all it's doing is saying my temp column is not allowed to absorb that. When I go underwater, my unrestricted column gets punished by the 14. And in years where I start to earn back that money, it will flip backwards the other way. So this is really just a placeholder, not a big deal, but it just shows you the underwater amount. At the end of the day, and the reason why this is so important, and if you leave with nothing else, you can answer this question to anyone that asks. People always used to ask me, what's my endowment worth? Not what's in it, what's it worth? And I never used to be able to answer that question because this note didn't exist. I can now tell you at the end of the year, your endowment is worth $28,421,012, right? That's the sum of all the gifts you got from outside donors, your quasi-endowment that the board stuck in endowment, and the earnings off of those pieces, right? So now you can answer that question. That's how we're doing. That's what we've earned. That's where we are. That's at some point in the future what we could spend, right? Okay, so that's it. Any questions?